Well, for more on the Great Recession, the global financial crisis that followed, and how it shaped the US and global economy, I'm joined by John Tamny. He's an editor for Real Clear Markets and political economy editor for Forbes magazine. Welcome back to the show.
Thanks for having me.
So, as a reporter who covered this, seeing Lehman Brothers fall and the domino effect from the housing crisis, just walk us through what it felt like to see all this unfold.
It was terrifying at the time, but realistically, what was more terrifying is watching the ineptitude in Washington. It can't be stressed enough that this was not a financial crisis. This was a crisis of intervention in Washington. Simply put, if they do not bail out Bear Stearns, there's no expectation that Lehman Brothers is going to be saved. Lehman only shook the markets because there was an assumption that what happened for Bear was going to happen for Lehman. If you properly let Bear Stearns go, this is how business sectors evolve. You let the laggers fail. Lehman goes probably much sooner, but the markets are ready for it and there's no crisis. Let's never forget that the intervention caused the crisis. Never could a business failure cause something like this. Enron, several years before that, was a much larger corporation, much more global interconnectivity, and it failed without anything like this. It's when you intervene that you cause the crisis.
So for individuals and companies, what was their biggest concern at that time?
Well, I think, as with anything, when you are dealing with a counterparty that may not show up to pay a bill or may not show up to take the other side of the trade, that's dangerous. Look, there's always going to be fear in the middle of what is of a company going under. But let's be clear, I'm hearing 3 former U.S. senior officials who led this bailout process saying that the economy was on the edge of ruin. Really, how? How could the failure of a business weaken the economy? That's the equivalent of saying that Silicon Valley is in constant crisis mode, given the fact that 9 out of 10 businesses there fail on an annual basis. Just about everything goes under. GM's worth, what, $150 billion today? Well, so is Netflix. Would anyone say we've got to bail out Netflix because it's worth that much?
Right.
Any business sector evolves precisely because there is failure. Silicon Valley is successful because we don't bail anything out. How is banking any different? It's never been explained.
So why do you think that the Federal Reserve and the U.S. Treasury didn't have a better handle on what was happening with the banks?
Well, if they did, they wouldn't work at the Treasury and or the Fed. Let's be clear. If anyone knew this was going on, the people who predicted a crack up within financial institutions made a lot of money. If you can see into the future like this, you certainly don't work as a bureaucrat at Treasury. And so you're asking the untalented, in many instances people who couldn't get jobs on Wall Street in the first place, to see into the future in a way that if you were an investor, you'd be worth billions today. And that's the point. The point is we get growth from our failure. Economies gain strength from periods of weakness because it's during those weak periods that bad ideas are put out to pasture, that bad habits are basically erased, that lousy businesses are basically put out of business so that good ones can replace them. Why did we not allow that to happen then? If we love Wall Street, and I love Wall Street, I think it's essential for global economic growth to have these talented financiers. If you love it, you must let the laggards fail. If you don't, if you work against what the market wants, and the market wanted Lehman to go under, wanted Bear to go under, you get crisis.
So, as we heard there from former Prime Minister Gordon Brown, he talked about all these disruptions that we're having between global leaders. Just how prepared is the global economy for another financial crisis?
Well, in a sense, I hope that Gordon Brown's correct. The problem was the governmental response around the world. How could you improve a global economy by propping up businesses that private investors said were no longer worth propping up? That's the equivalent of us going back in time to Silicon Valley in 2001 and saying, you know, Webvan, eToys, theglobe.com, let's keep them and keep them in operation. Let's prop up Friendster. Let's prop up all the Yahoo and Netscape, some of these businesses that are long gone. It would weaken Silicon Valley. You do the same thing to banks if you prop up the past. We've bailed out Citigroup 5 times in 25 years. Can anyone say that's been a good thing for the U.S. economy and the global economy more broadly? So the answer is a lack of government activity. It was the government activity that caused the crisis.
So with that being said then, what, if any, lessons have been learned from all this?
Well, clearly, very few lessons have learned judging by the description. It's still called a financial crisis when, in fact, investment banks and financial institutions have been failing forever. And that's been a sign of economic health. Let's never forget, they're supposed to take big risks. That's the business they're in, and they are very much an ephemeral business. But if you suddenly start saving one, not saving the other, you create uncertainty in the market. When an administration like the Bush administration did what it did, whereby it banned short selling, in doing so, it banned buyers. Short sellers must re-enter the marketplace to buy the shares they sold short. When they were needed most, government intervention kept them out. So let's be clear, this crisis was man-made in Washington. I think it gives me more confidence if there's not a coordinated response, because it was the coordinated response the last time that shook global markets to their core.
Now, let's also look at some of the legislation that came out of this DoddFrank consumer protection legislation. The policies that were put in place, how effective were they? And how are we seeing that change as new governments have come in since that financial crisis?
Well, of course they weren't effective. The financial institution business, or the finance business, is one of the most competitive on earth. And by virtue of that, you already have the ultimate regulation. If you do badly by your customer, if you give them a bad product, they can go elsewhere. Why would you need people who, once again, could not get jobs in these industries to somehow police those who could? What makes you think that that's going to work? And so Dodd-Frank was a waste of time.
So then does it make a difference then if the Trump administration is trying to change that?
No, it doesn't make it at all. And in fact, and I've been very critical of the Trump administration on this very show, but in this one instance, the Trump administration is correct in defanging the CFPB. What could those who work there possibly do to create a better financial outcome? The reality is Goldman Sachs has got the most talented and richest clients on earth. Do you think Goldman can bilk them? On the lower level, do you think E-Trade can bilk its clients when Charles Schwab and all sorts of other businesses are trying to get that business back? You've already got the ultimate regulation in the financial services industry. It's called competition. To add this in is just to bring waste into the equation that achieves much less than nothing.
All right, always good to have your insights. John Tamny there, editor at Real Clear Markets and political economy editor at Forbes.